Why does a crypto token suddenly jump 20%, then give it all back before you have finished asking what happened? The short answer is not simply that more money entered or left the market. Price moves when buyers and sellers compete for the limited amount available at that moment. Supply matters, liquidity matters, leverage matters. And sometimes the story people believe matters more than what the network is actually doing. Start with the simplest idea. A crypto price is the price of the most recent trade. It is not an official valuation calculated by the blockchain. If the last buyer accepted $10 per token, the displayed price becomes roughly $10. If the next available seller wants $10.20, an eager buyer may push the price there. This is marginal buyer and seller pressure. Marginal means the next trade at the edge of the market. Prices rise when aggressive buyers consume the tokens offered for sale faster than new sellers appear. Prices fall when aggressive sellers hit the available buy orders faster than buyers replace them. Imagine an exchange order book. Sellers are offering tokens at $10, $10.05, $10.10, and so on. A small purchase fills only the first level. A large market order may sweep through several levels, producing a higher average purchase price and moving the displayed price upward. That brings us to one of crypto's most misunderstood numbers. Market capitalization is the circulating token supply multiplied by the latest market price. It is not the amount of money invested. Suppose a token has 1 billion units circulating, and the latest trade happens at $1. Its market cap is now $1 billion. That does not mean buyers deposited $1 billion into the token. Perhaps only a small fraction of the supply traded near that price. Now imagine a few purchases push the latest price from $1 to $1.10. The calculated market cap rises by $100 million. But $100 million did not necessarily enter the market. The entire circulating supply was simply revalued using the new marginal price. This is why two tokens with similar market caps can behave very differently. One might have deep order books and heavy daily trading. The other might have very little available near the displayed price. Market data for major crypto assets routinely shows large differences between market cap, circulating supply, and trading volume. That difference is liquidity. Liquidity describes how easily an asset can be traded without moving its price dramatically. A liquid market has many buyers, many sellers, tight gaps between their orders, and meaningful depth on both sides. An illiquid market has thin order books, wider spreads, and larger slippage. If this explanation is making the market feel less mysterious, subscribe. We break down crypto mechanisms without the hype, one moving part at a time. Liquidity also matters on decentralized exchanges, although the mechanism looks different. Picture someone buying a small token using USDC. The user chooses the amount and confirms the swap. Their wallet signs a transaction authorizing the smart contract to exchange their USDC for the token. The transaction is sent to the network. Once confirmed, the automated market maker takes USDC into its liquidity pool and sends tokens out. Because the ratio between the two assets has changed, the pool's quoted price changes too. A large purchase against a small pool can move that ratio sharply. If the price changes beyond the user's slippage limit before execution, the transaction may fail. If the limit is loose, the trade may complete at a much worse price than expected. Thin liquidity is the main weakness here. The chart can shoot upward when buyers arrive, but those same buyers may discover there is not enough liquidity to exit near the displayed price. Next comes token supply. Bitcoin has a programmatic issuance schedule and a hard maximum supply. Other crypto assets may have continuous inflation, discretionary issuance, token burns, or billions of tokens waiting to unlock. The most useful distinction is between circulating supply and total potential supply. Circulating supply is the amount considered available in the market now. Total or maximum supply includes tokens that may be released later. A project might launch with only 15% of its tokens circulating. The rest could be reserved for the team, early investors, a foundation, community rewards, or future incentives. This low initial float can make the token easier to move because relatively few units are trading. It can also create a large future supply overhang. When locked tokens become transferable, that is called an unlock. An unlock does not guarantee selling. A recipient can hold, stake, or use the tokens, but it creates the possibility of additional sell pressure. The key questions are how large the unlock is relative to circulating supply, who receives it, and whether the market has enough demand and liquidity to absorb it. Exchange listings affect the other side of the equation. A major listing can give more people access to a token, add new trading pairs, and attract market makers. That can increase demand and improve liquidity, but the effect is not automatically positive. Early holders may use the new liquidity to sell. If traders purchased only because they expected a listing, the actual announcement can become the moment they take profits. Staking adds another layer. Staking can temporarily reduce tradable supply because holders lock or delegate tokens to help secure a proof-of-stake network. The prospect of rewards may also create demand for the token, but staking yield is not free money. If rewards come from newly issued tokens, the network is expanding supply. A 10% token yield means little if inflation is high, the token price falls, or recipients continuously sell their rewards. Staking can reduce liquid supply today while creating new sellable supply over time. Then there are stablecoins. Traders often describe stablecoins as crypto's dry powder because they can be exchanged for volatile assets without first moving money through traditional banking rails. When more stablecoins enter exchanges or decentralized finance, buyers may have more immediate purchasing capacity. Still, a stablecoin inflow is not proof that prices must rise. The funds might be used for lending, payments, market making, or derivatives collateral. Stablecoins can indicate available liquidity, but they cannot tell you what people will do with it. Leverage can turn an ordinary move into a cascade. A trader may deposit $1,000 as collateral and open a position worth several times more. If the market moves against that position, the exchange may liquidate it to prevent the loss from exceeding the collateral. Suppose prices begin falling. Leveraged long positions reach their liquidation levels, and exchanges automatically sell assets or close those positions. Those forced sales push the price lower, triggering more liquidations. The same mechanism can work upward when leveraged short sellers are forced to buy back assets. This explains why crypto can move violently even without a single dramatic piece of news. The first move may be caused by normal selling. The larger move may come from automated liquidations, stop orders, weak liquidity, and traders rushing toward the same exit. Now we reach narratives. A narrative is a simple story about why a category of crypto assets could become important. Previous cycles focused on themes such as decentralized finance, NFTs, blockchain gaming, and meme coins. Current discussions include stablecoin infrastructure, tokenized real-world assets, AI-linked crypto, prediction markets, perpetual exchanges, and privacy technology. Narratives matter because markets price expectations, not only current results. If traders believe a new technology will attract users, revenue, or institutional attention, they may purchase related tokens before that growth appears. Rising prices then attract more attention, which attracts more buyers, reinforcing the story. But a narrative is not evidence by itself. A token can include the words AI, gaming, or real-world assets in its marketing without creating meaningful demand for the token. Different projects grouped under the same theme may also have completely different economics, products, and risks. This is where actual network usage enters the picture. Useful signals can include demand for block space, transaction fees, stablecoin settlement, active applications, developer activity, protocol revenue, and whether users return after incentives end. Even genuine usage does not automatically make a token valuable. Ask whether using the network requires the token. Does activity create fees paid in it? Are tokens burned, locked, or needed as collateral? Does value flow to token holders, validators, or only to the company and applications built on top? A network can be busy while its token supply grows even faster. It can report thousands of users who are mainly collecting rewards. It can generate fees that are tiny compared with its token valuation. Fundamentals matter, but the connection between the product and the token must be real. So when a crypto price moves, do not search for one magical cause. Check the marginal buyers and sellers. Look at liquidity and trading depth. Compare circulating supply with future supply. Review unlocks and emissions. Consider listings, stablecoin flows, and leverage. Identify the narrative, then ask whether real usage supports it. Most importantly, remember that volatility and uncertainty are forms of financial risk, and greater potential returns do not remove the possibility of substantial loss. Crypto prices are not random, but they are produced by several systems interacting at once. Once you understand those systems, the chart stops looking like a mysterious line and starts looking like a record of supply, liquidity, expectations, and human behavior. If you have a question, leave it in the comments, or tell us which crypto mechanism you want explained next.